Good morning. I'm Benjamin Sullivan, and welcome to Market Monday for February 23rd, 2026. Worry was again the prevailing emotion last week, as markets mulled the possibilities of strikes and hikes and bears. Oh my! The S&P 500 continued to trade in a narrow range this week, closing Wednesday at 6,881 before pulling back Thursday. Bond markets continued to rally, with yields falling after last week's cooler than expected CPI inflation report, which reinforced expectations that the Fed will cut rates later this year. On Thursday, Walmart reported fourth quarter results, beating estimates on both the top and bottom lines. Revenue came in at $190.7 billion, with adjusted earnings of 74 cents per share. Most importantly, Walmart functions as a pulse check for low to middle income consumers, and the results continue to show a division in the economy. Same-store sales rose 4.6%, driven by e-commerce growth of 27%, and the company continued to gain market share among households earning over $100,000. However, management struck a cautious tone, issuing full-year earnings guidance of $2.75 to $2.85 per share, well below Wall Street's expectation of $2.96. Walmart's CFO described the backdrop as somewhat unstable, noting that lower-income consumers are still managing paycheck to paycheck. Looking ahead, the market awaits Nvidia's critical earnings report next Wednesday, closing out a pivotal earnings season for AI and the market as a whole. After Meta announced a multi-year partnership deploying millions of Nvidia chips in its data centers, high expectations have driven the stakes ever higher. Wednesday's release of the January Federal Reserve's meeting minutes revealed a divided committee. While members largely supported holding the benchmark rate steady at 3.5 to 3.75%, two members predictably dissented towards a rate cut. This meeting, however, several members signaled they'd be open to rate hikes if inflation stays above target. This development marks a meaningful shift in tone that adds uncertainty to the expected cutting cycle. On Friday morning, we received the delayed economic data that helps frame the Fed's dilemma. Fourth quarter GDP came in at a frigid 1.4% annualized, a very sharp deceleration from the third quarter's 4.4%. Meanwhile, the Fed's preferred inflation gauge, the PCE price index, ticked up to 2.9% year over year as of December, with core PCE rising to 3%. In short, inflation is moving in the wrong direction while growth seems to be slowing. This creates an economic environment that makes the Fed's job incredibly difficult. Despite the uncertainty, markets are still pricing in rate cuts later this year, and yields are expected to fall through year-end. For investors sitting on idle cash in money markets or savings accounts, this is worth paying attention to. The attractive yields we've grown accustomed to for the past 5 years are fading, which signals that it's time to consider putting that cash to work in assets with better return potential. Meanwhile, oil has surged to $66 a barrel, and gold sits close to the highs, trading around $5,000 an ounce, as geopolitical tensions between the US and Iran continue to escalate. After the second round of nuclear talks in Geneva produced little progress, reports emerged that the US military is prepared for strikes soon. Energy stocks rallied on the news, and the situation remains fluid heading into the week. The chaotic headlines of AI disruption, geopolitical tensions, mixed economic data the past 2 weeks have been noisy. It's easy to let the headlines pull us away from our plans. But as we always say, we're investors. We accept the short-term volatility and stay focused on the long-term results. Similarly, with all of the noise in our everyday lives, it can be difficult to keep up with our plans for the future. It's important to set aside time to take a step back and think about estate planning. Do you have your estate documents in order? And do you know where they are? Are your wills, trusts, beneficiary designations, and healthcare directives current. Think about who do you want in charge of your affairs, where you want your assets to go, and to whom. Most importantly, get the next generation involved now. These conversations aren't always easy, but having them today can save your family significant stress and confusion down the road. If you need help getting started or reviewing your current plan, please reach out to us. That's what we're here for. That's all we have for you today. As always, thank you for watching this week's edition of Market Monday. We look forward to seeing you again next week.